The ECB is widely expected to cut rates tomorrow. Welcome to Market Insight. I'm Ramzan Karmali. Well, the Eurozone looks set for a much-needed financial boost on Thursday, when the European Central Bank is forecasted to start lowering interest rates for the first time in 5 years. The anticipated move by ECB policymakers puts them ahead of their counterparts at the US Federal Reserve, who are still grappling with seemingly more persistent inflation. But after tomorrow's rate decision, the picture for Eurozone rates looks a little murkier. So will this rate cut be an isolated one for now? Well, to help answer that and more, I'm joined by Russ Mould, Investment Director at AJ Bell. Russ, thanks so much for joining us. Well, let's start with the ECB. European policy rates now stand at their highest in more than 2 decades. What would starting a new easing cycle mean for the markets?
Well, I think the markets have been anticipating that easing cycle for some time. That's why you've seen indices such as the DAX of Germany and the CAC 40 of France move to new all-time highs, and Europe overall perform pretty respectably. So if anything, there'll be quite a lot of disappointment if the ECB doesn't act tomorrow, particularly when they trilled it so clearly back in May.
Now, predicting the future, though, isn't so clear-cut when it comes to the ECB and cutting rates. What are you expecting for the rest of the year?
I think there is a hope for further action going forwards. There'll also be hope that the ECB may slow down the rate at which it's shrinking its balance sheet, as we've seen the US Federal Reserve do. So I think there is a feeling that, rates have peaked, that policy will ease. But again, how quickly, there are lots of different variables there. The oil price could start misbehaving again. Though at the moment, that is going in the correct direction for policymakers. So that may make future decisions a little bit easier for them.
You mentioned the Fed there. Well, there's been some noise this week that suggests a September rate cut could be back on the table. What's your view?
Always lots of noise, Ramzan. It keeps us in business, so that's no bad thing. But if you look at the CME Fed Watch survey, that is suggesting that markets have gone back to pricing in 2 rate cuts from the Fed this year, 1 in September, 1 in December. That's still much less than the 6 that was being expected at the start of the year. And the US 2-year Treasury rate, well, that's trading at around 4.75%. So that's pricing in 3 quarter-point rate cuts over the next 2 years. So again, an easing is expected, but a relatively gentle one, perhaps.
Well, let's have a look at some economic data that came out today. The latest PMI data in the UK indicates a deceleration in services and manufacturing sectors in May, whereas in the Eurozone, the composite reading has hit a 12-month high. What's happening here?
Yeah, nothing too untoward, I don't think, in the UK number. I mean, that services reading particularly was the 7th consecutive one above the 50 level, suggesting of future growth. Again, perhaps consistent with the feeling that the UK is crawling out of that shallow recession, albeit not at tremendous speed. And yeah, again, the Eurozone, like the UK, will have benefited from lower energy prices, decent wage growth, relatively low unemployment, and I suppose also hopes for those interest rate cuts.
Now, let's move on to some corporate results. The market seemed to like what they heard from Zara owner Inditex earlier today. Are you in agreement?
I'm not going to argue with the market, Ramzan. It's a lot smarter than I am. And the shares are up 5%. They're back to near an all-time high. It's interesting, the actual first quarter numbers themselves were no better than expected, if anything, a little bit light. Sales up 7%, profits up 10%. That was a bit of a slowdown from the run rates we saw in the fourth quarter. But what the investors seem to have latched upon is the forward-looking statement talking about an acceleration in sales in May to 12% year-on-year growth, with management flagging nothing more complicated than better weather. I think that's probably selling themselves a little bit short, given how well they manage their product range, how well they get it to market, and the value that they offer. But that I think is probably why the shares are responding so positively today.
Now, store closures have decimated much of Britain's high streets, but discount retailer B&M has opened more stores and looks to open even more. But the markets aren't that impressed, are they? Why?
No, it's a really interesting contract. Inditex, the numbers were not better than expected, but the outlook statement was positive. BME European Retail, the numbers stated for the full year to April were excellent, but the lack of a forward-looking statement seems to have upset people there. Again, strong double-digit growth in sales, profits, and increased dividends, strong cash flow. But all management talks about for the future was, as you say, was future store openings, cost efficiencies, and a continued focus on value. They've often given a slightly more specific focus on profits before, or guidance on profits before, so perhaps that spooked a few people today, and that's why BME is the worst performing stock in the FTSE 100 right now, down 6%.
Russ Mould, as ever, from AJ Bell, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.